Good morning, everyone, and welcome to this panel, Institutional Yield Management. I'm Sunny Kwon from Tokenpost. We are a leading crypto media in Korea with about 5 million monthly readership. And together with our esteemed panel, we're going to explore how institutions are finding yield in crypto and how they manage risk in this new frontier. As you all know, interest rates globally are rising, so the bar for attractive returns is very high. We'll ask, can crypto yield opportunities measure up? And if so, how can they be harnessed safely and at scale? So let me briefly introduce our speakers. So we have Alessio Quaglini, CEO of Hex Trust. It's a leading digital asset custodian, helping institutions stake and earn on their crypto. Then we have Louis Kim. He's a CEO of HappyBlock, who's building a platform right here in Korea to connect institutional investors with digital assets, yields under a compliant framework. We have Giovanni Sana, co-founder of Cleos, which offers an app for earning USDC yield through curated strategies, complete with crypto Visa card for spending those earnings. Thank you for all joining us today, and let's dive in. Where are we seeing the best yield opportunities for institutional investors right now in crypto and in traditional markets? So Alessio, perhaps you can start by comparing what yields are available on chain versus, say, traditional fixed income, and how do things like DeFi lending or staking yields stack up against something like the US Treasuries today?
Sure, thanks. Maybe we can start by really looking at what is available today on chain, right? Because there's a lot of confusion, there's a lot of things, as you mentioned, staking, yield for stable coins, etc. But how do all these deals actually boil down to the risk reward that people want to get exposure to? So if we look at the different types of yield available on chain, we can really break them down into three broad categories. The first one is basically the yield that is generated by the blockchain protocols. This historically is basically the yield that comes from a proof of work, or right, in today's world more from proof of stake. So basically it's the yield that is generated from your assets when you delegate them to basically ensure the safety and the functioning of the network. So the protocol yield. The second yield is basically yield that comes from financial markets activities. So this yield coming from financial markets activities really depends on a number of things. The basic things are usually for example, the yield that comes from basis arbitrage, so going long spot and short perps, or the yield that comes from lending, secured or unsecured on different marketplaces, or the yield that can come from, for example, farming rewards in the DeFi space. The third category of yield is the yield that comes from RWA. So it's basically yield that doesn't exist, does not come really from on-chain activity, but comes from the TradFi world, and that is transported or mirrored on-chain with tokenization or basically RWA representation. Now, the basic, I mean, usually the most common yield for this is basically the money market funds, or basically the T-bills that have been tokenized on chain. Now, the interesting thing about blockchain yield versus TradFi is that in TradFi, you only have at each time one category of yield. So you want to buy the T-bill yield, you buy a T-bill. You want to buy the 10 years, well, it's more or less the same because the curve is flat at 4% more or less. So you would buy the 10-year bond. In the blockchain space, you can actually use what we call Lego finance to put together all these different yields. So for example, you can stake your ETH, obtain a token that's basically the liquid stake token for ETH. You can then collateralize it and use this kind of the stable coins that you borrow against it to basically lend in a lending market. So you can actually build different kinds of risk and rewards together. And maybe just to conclude, I would say the next step is what people are building in terms of restaking activities. So you have basically an exposure to staking. You have the staking token, and then you can delegate the staking token to different AVSs, which are basically other risks, and basically build different levels and layers of risk on top of your investment. This is only possible in the blockchain world today, and in traditional world you need very sophisticated investment banks to structure these products for institutional investors, but in the blockchain world it's basically through Lego Finance and different DeFi protocols is available to everybody. I think this is a very interesting proposition that the blockchain world has, and that is not really commonly understood in terms of value add that has been created on chain.
Thanks. Louis, anything to add on where you see an attractive yields? Are clients chasing tokenized real-world yields with like Boden tokens, or more like the crypto native stuff like staking?
Normally, the higher yield means the higher default probability of the default, and
Yes.
also the in terms of the risk neutral and the risk free, higher inflation rate in the currency, so that this is different from the country side or the investor side, where they are in their own circumstances. So that for DeFi, everyone can access to here using the stablecoin and other Ethereum or other staking possible tokens, so that this yield is still high for someone, but for some reasons in the innovative countries, I think it's going to be a little bit low. But for the country in Korea, I mean the investor in Korea, they think it's good enough because our inflation is growth rate is getting lower, and also the internal return rate in Korea is getting lower. So that that's why I think many of the Korean people love to trade in the U.S. stock market and also the crypto exchanges.
Giovanni?
Yeah. What we're seeing today is definitely something totally different compared to what we saw in the crypto hill for early DeFi days. If we saw, for example, 2020, where we had APY ranges like 50 or 100%, there was another time. And the point today is not like find just the double-digit return, but more looking around and towards something sustainable and risk-adjusted. This is because I think strategies became more sophisticated, but also, as Alessio said, on RWA, new standards and regulation comes, so definitely the yield are on another perspective than was before.
So here we can definitely acknowledge that the yield is everywhere now, whether it's TradFi or DeFi, and the real question is how we can access it, how to access it safely. So as we all know, higher yield, as you said, Louis, usually means higher risk. So in traditional finance, that risk might be credit risk of a bond issuer. In DeFi, it might be a smart contract or protocol risk. Louis, coming from a traditional finance background, how do you think institutions view the risk around DeFi yields? What do they need in order to get comfortable? For example, do they insist on things like legal guarantees, collateral, or insurance before touching any of these DeFi products?
Yes, once I had a chance to describe the DeFi product to the institutions in Korea, they'd love to hear this is quite similar with the capital bond, so which is collateralized with a car or a boat, any other vehicles in the industry, so that it always compelled with the value of the capital bond is compelled with the value of the collateral and also the credit of the issuers. So likewise, they want to credit scoring the every DeFi service, though we don't have a credit scorers companies. So this is one thing we need to figure out, and then when we are using the protocols, our counterparty is basically the protocol itself. We don't know who is the counterparty exactly, where the wallet is coming from. So in that, I think basically what they want to ensure is the institutional grade investor or the other family house or other the players are coming into this DeFi first. And secondly, basically, you know, that the DeFi service users are using their own wallets, so that they need a, you know, even the BitX already mentioned about their service like prime custody, so that the normally institution investor, they access to the market using the prime custodies, so that the trust on this custody and also the executors operating, you know, internal control is very important. So that in that they need a kind of risk matrix on this. So this kind of access is required for the next market. So yes, so I think the at the aspect of the, you know, measuring the risk, I think most important thing is DeFi's, you know, inflow and outflows, like how many collateral are inside and how the speed of the collateral accumulated, also how many active users are using this. And so this means network is very healthy. So then it will, you know, finally let them understand that this DeFi protocol is, you know, credit worthy. So yes, good thing is DeFi has no need to require collateral like the exchange. So when we use the exchanges, sometimes we think the credit risk to the exchanges existed. We need a collateral to them. But DeFi is always, you know, trustless, so that in that we think every credit risk is coming from the operational risk right now.
Okay. Thanks for the answer. Alessio, Hex Trust works with both DeFi and traditional clients. Do you see difference in how this risk is assessed?
It's totally different. At Hex Trust, I mean, thanks. Obviously, we were born as a custodian, so for us, custody and security is really at the core of our operations. We're one of the leaders, especially in Asia, in the Middle East, in Europe. Going to your question, so we do serve two categories of clients: institutional investors, and I would say crypto-native DeFi protocols or foundations issuers. Their requirements are slowly converging, but historically were completely different. Let's start with DeFi protocols and foundations. What they care about is basically the execution of what they want to achieve. So they're usually extremely sophisticated in terms of what they need in terms of access. So some of our clients are the big foundations, Ripple, for example, Hedera, Algorand, etc. And some of the DeFi protocols. So what they need is basically a platform that, yes, it is secure, but at the same time allows you to do as many things as possible in a very quick and simple way. So you need to be able to take your assets, you need to be able to natively stake them. You need to be able to spin up different validators and allocate assets across different validators dynamically so that the governance of the network stays decentralized. You need to be able to sign raw transactions, access wallet connect, different types of DeFi protocols, on-chain collateralized loans, etc. So these are really the needs of, I would say, crypto-native DeFi protocols. On the other side of the spectrum, you have the institutional clients. Their requirements in terms of access are usually much simpler. What they really care about is exactly the legal framework around their assets. They want to make sure that, first of all, the operations that we run are as secure as possible. And this is usually guaranteed by the fact that the entities that they deal with have licenses in place, etc. And at the same time, they want to make sure that even if something goes wrong, their assets are legally protected. So they care about certifications, they care about licenses, they care about segregation of assets, bankruptcy, remoteness, right? So that if other creditors need to line up for the in the bankruptcy of the company, their assets are segregated and nobody can take them. Now, the two worlds are, I would say, slowly converging, because even DeFi protocols or issuers of tokens, they're slowly starting to operate in the more regulated space, and they're asking more in terms of licenses and certifications. Why? It's not really coming from the crypto space, it's coming from the fact that their investors are asking them to go in that direction. So if you want to get investments from the large fund houses, say Franklin Templeton, Fidelity, etc., these investors, they'll basically require the investee company, so the DeFi protocol, etc., to put in place some safeguards, some controls, some governance, etc., so that the assets of the DeFi protocols are protected, and in turn the investment of the institutional investors are protected.
All right. Yeah, we want to share as much as we can, but we are tight in time. So if you guys can be brief. And so one of the exciting trends is tokenized real-world assets. It's pretty big in Korea, RWA. Essentially bringing traditional yield-bearing assets like treasury bills or real estate loans onto blockchains. Giovanni, how do you see RWAs fitting into the yield strategies or platforms like yours incorporating things like tokenized treasury yields or tokenized credit?
Yeah, so tokenized RWAs are definitely one of the most exciting trend that we are facing in this year, because if you think about bridge something that is traditional assets, as we can see at treasury bonds or real estate or whatever, with the blockchain efficiency. In fact, for example, if I get an X return on a tokenized T-bill, this is attractive for sure, but at the same time, the main focus here is on the issuer and the custodian, so these key parts are quite important. On our side, we integrate already one RWA, which is a tokenized T-bill, but not standalone, just with inside one of our earning plans. So essentially, user can select one of our earning plan and get the exposure. So not direct exposure, but the point is that we avoid a direct user to have potential issues with the custodian or the issuer, while we manage all of that in terms of institutional risk framework. So that's what we are looking for. And getting this kind of institutional risk and yield exposure to users is our focus. And lastly, I want to say that it's clear that conservative investors are already, start to invest in this new, let's call crypto yield and asset class, but the bigger ones are not jumping yet. So we will see for sure lots of development in this space.
Well, thanks. Maybe Louis, could you maybe mention any local developments, like from the Korean funds, or even what's holding back the bigger adoption? Is it the regulatory uncertainty or things that are lacking in secondary market liquidity?
Oh yes, still we have a regulatory framework on the STO, so that basically secondary market for on the on-chain is impossible right now. But we are seeing how the stablecoin is moving on from the bank side and also regulatory side, and then so this is kind of steps that first we can use the Korean won stablecoins, then we're gonna have access to the RWA based tokens, and then we're gonna have a compare in the market on demands, so between the real treasury bond and RWA based tokens.
So generally, overall, infrastructure has matured and is maturing. Example, we didn't hear about banks staking crypto 3 years ago. So now it's increasingly standard globally. As we are short in time, I will skip some questions. I would love to share, but so I want to spotlight what each of your firms is doing to help institutions capture yield. Perhaps in 1 minute each, can you highlight how your platform is addressing institutional needs for yield and safety? Starting with Alessio.
Yeah, I mean, very, very simple from our side. Basically, our platform is a full custody, staking, trading, yield generation platform for institutions in a regulated way. So basically, in terms of banks or institutional investors, we offer full APIs for custody and to connect with DeFi protocols to generate yield, and basically to still via APIs access all the different staking protocols that we support on chain. So basically, we offer, I would say, an off-the-shelf solution for any banks, neobanks, fintech companies, payment provider that basically wants to access not only digital assets but the whole yield generation all in one.
Right. Louis?
Yes, from 2025, the institutional market is open in Korea, so that the DAT companies are appear right now. So we are supporting for them to manage the Bitcoin, Ethereum, to provide their investors the Bitcoin yield and also Ethereum yield well. So next step is going to be our pipeline providing for their market access to the the option or other structured product, so that they can manage their own portfolio inside, compatible with the investor risk appetite. So in the end, I think as this market is growing, so more and more prime custody and prime brokers are required in here. So in that, we are going to manage the qualification, in terms of security and the trust. Yeah, that is the goal of ours.
Giovanni?
Yeah. So Cleos is about institutional grade yield accessible to everyone, not just for the institution. So what we do, we start selecting a regulated investment manager. We apply an internal risk framework, due diligence, and investment committee. Once everything gets into our criteria, we package into specific earning plans. That's how we like to give people exposure to these crypto yields. At the same time, the big point for us is the experience, because you have in a seamless app this crypto yield on an institutional grade base and direct expenses with the Visa card, everything connected. So we like to get simple access on a seamless platform to people to manage, yield, and spend seamlessly, which is our goal.
Great. Before we wrap up, I'd like each of you to share one key insight or prediction for the future of institutional yield management. For instance, you see a future where every institutional portfolio has a crypto yield component like staking, some DeFi, alongside bonds and banks. Basically, what's your take-home message for investors here interested in this space? Starting from.
I mean, we've seen basically the largest asset managers and pension funds starting to allocate to crypto, maybe starting with 2, 3, 4, 5% or whatever, but it's only going to increase. When you hold crypto, at the same time, giving up, for example, the staking yield is basically missing out on, I wouldn't say risk-free, there's always a risk, but basically it's kind of missing out on the inflation rate of the network, right? So what is going to happen now? We have the first ETFs. They don't even offer yield on Bitcoin, for example, but we'll start seeing all these components being added not only to the DeFi products, but also to the institutional products. So wrapped up within a regulated institutional product, distributed to institutional investors and to retail, but including the yield components that are currently missing.
Louis?
So as much as asset is converted to the token, I think it's a competition between the central bank and the finance institution and DeFi, and also the capital market. So that, for example, DAT company, they can convert to the tokens, and central bank, their currency is going to be token. Everything is going to be token. Then it's kind of cross-currency, swap market in there. So liquidity and yes, credit, trust is very important. So that I think that's the hit point in the near future.
Thanks, Giovanni.
Yeah, I can see yield will be diverse for sure. We'll get more AI, for example, managed strategies that can, for example, optimize protocols. But the yield will be more user-oriented, and I vision we can see also more in daily life the expenses of this crypto yield. And people will not have the perception that they are spending technically DeFi yield or crypto yield native. Like today, it comes from a traditional finance or saving accounts, technically.
So we are on time, so we'll have to leave it there. Thank you, Alessio, Louis, and Giovanni for sharing your thoughts. And thank you for listening. I hope this gave you a very clear picture of how to approach yields in this evolving landscape, whether you're coming from crypto or from traditional background. Enjoy the rest of Korea Blockchain Week. Thank you.